Markets are closely watching for signs of declining U.S. inflation, Federal Reserve rate cuts, and the likelihood of avoiding a recession. These issues will come into sharper focus with the release of the November employment report next Friday, according to Scott Anderson, chief U.S. economist at BMO Capital Markets. The labor market has defied expectations and remained robust throughout the year, which has bolstered consumer spending and income. However, there is speculation that the strong payroll growth seen from July to September may not continue. Key economic updates are anticipated, including the October JOLTS report scheduled for release on Tuesday at 10 a.m. Eastern Time. Economists expect job openings to decrease to 9.4 million in October, down from 9.6 million the previous month and lower than the 10.5 million job vacancies from the previous year. This expected reduction has been positively viewed by the Biden administration and the Federal Reserve. It reflects the possibility of reducing job vacancies without increasing the unemployment rate, as Federal Reserve Governor Chris Waller suggested. Avery Schenfeld, chief economist of CIBC Capital Markets, has predicted even fewer openings, around 9.2 million, signaling a potential easing in labor market tension. The November ISM Service Sector Index is also anticipated on Tuesday at 10 a.m. Eastern Time. Experts predict a slight increase to 52.5 for November from 51.8 the prior month after 2 months of decline. There was concern that the index might fall below 50, signifying contraction, a level not seen since December 2022. A significant drop in the service sector could lead experts to predict an impending recession. Economists are expecting the November jobs report, due on Friday at 8:30 a.m. Eastern Time, to reveal that the U.S. economy added 190,000 jobs in November, an increase from 150,000 in October. They forecast the unemployment rate to remain at 3.9% and wages to rise by 0.3% in November. The annual wage gain rate is projected to decrease to 3.9% from 4.1%, aligning with the trend of diminishing inflation. It is noted that the jobs report might reflect the return of strike workers and be influenced by seasonal hiring, which is expected to be less robust this year. Richard Moody, chief economist at Regions Financial Corp, believes the headline figures of job growth will mask a decline in labor demand, highlighting that the slowdown has been due to reduced hiring rather than increased layoffs, a pattern whose change would be concerning for the broader economy.